Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the low time frame bullish scenario where we're looking for an ending diagonal in a wave 5. Either this ending diagonal is the end of a higher degree wave 5 and we are then looking for a big retracement to the downside, or this diagonal becomes a leading diagonal in only a wave 1, then we're looking for a wave 2 retracement before then continuation in a wave 3 to finish a higher degree wave 5. Now this scenario was first suggested by John, where he was then looking for zigzags in all of these structures over here, and that is also what you want to see in an ending diagonal, where all of the waves are zigzag A, B, C structures, or a double or a triple zigzag. And in a leading diagonal, all of the waves can be zigzag structures, A, B, C, or 5, 3, 5, 3, 5. But in this scenario, we are then looking for zigzags in all of the structures. Wave 2 here retraced to the 0.382, which is a less common target for a wave 2 in a diagonal. And for a wave 3, we are looking for price to actually move further towards the upside, because a absolute minimum target for wave 3 is actually the 0.618, taken from the low to the high of 1 to the low of wave 2. A common target for wave 3 is the 786 to the 886 area between 38.6k and 38.8k, and of course we're quite far away from that with the 0.618 sitting at 38.3k. After the wave 3 target is reached, which is also in confluence with the yellow target box that we have here between 38.5 39k, we are then looking for another move towards the downside in a wave 4 and then continuation up in a wave 5. Of course, these moves also have to be zigzag structures. If we then zoom in to the lower time frame, that means that from this low we are now looking for a 3-wave structure to the upside, because this has to be your wave 1, this has to be your wave 2 now, because in a diagonal, wave 2 has to be a zigzag structure, meaning this high is not allowed to be broken. If you think about a wave 2 and the fact the high got taken now means that this now has to be a wave 3. If we then look at this scenario to the upside, we need an ABC here with a very extended wave C to the upside, relatively short A, then we have a bit of sideways action in a wave B, looking then for a wave C to the upside, where again you want to see this target area being reached. It does mean that this wave C, as mentioned, has to go pretty high, right? It's usually the common target for a wave C is between the 1 and the 1.236, which already has been hit, right? The 1.618 is less common, but it can happen that a wave C can extend to almost like wave 3 levels, as we have seen in this range as well, where the 1.618, 2.618, and even the 3 has been hit in this range. So there's definitely potential for a wave C. It's just less common to see a wave C go that far. If we look at the low time frame more bearish scenario, we're looking here for a flat structure, where in this particular scenario we're looking for a wave A to the downside in a double zigzag. Then we have a B to the upside, which then over here can be a double zigzag, and then either a WX and then a Y to the upside over here, where we're looking for the same ABC, with the target for this expanding flat wave B being between the 1.236 and the 1.38, which is between 38.3k and 38.6k, after which we then want to see an impulse to the downside, 1, 2, 3, 4, 5, to lower prices to at least take the double bottom that we have over here at 35.6k. If we look at the wave Y targets, you can see the trend-based fib extension, the 0.618, 1-to-1, 1.236, and the 1.618. This trend-based fib extension is taken from the low to the high to the low over here, if this is the low of your wave X and then a WXY. The 0.618, as you can see, is in confluence with the 1.236, sitting at 38.3k, which is nice confluence, but of course it is still a little bit above price, right? So we definitely again need a bit of fuel to get price moving towards the upside. Now for a wave X, the 382 is a common target and has been hit. However, it is possible for price to also go to lower prices like the 05 and the golden pocket. Usually an invalidation for a double zigzag is hitting the 0.7, which is sitting at 36.3k. However, I do have another micro scenario where this is not just an ABC and you move up, but you actually move down once more, reach the target box we have here that I'll show in a second, and then continue to the upside. And that is this one over here. In this particular scenario, we're looking for that same flat on a higher time frame. So we are then looking for a WX and a Y and then we're looking for that wave C to the downside, right? Where this is then currently around your wave, like an estimation of your wave Y target area. If your wave X is going to retrace to the target box that we have here, where inside this wave X, we're then looking for a 3-wave A, ABC finished in a B, and then you're looking for a C to the downside. This target box is sitting between 36.4K and 36.6K, offering a bit of extra support for then a move towards the upside and the beginning of a wave Y again for higher prices. Now the double top has just been taken just before clicking on the record button over here, right? The 1.236 has just barely missed out over here, which is your most common target for a wave B, taken from the high of W to the low of wave A. So the 1.236 just above price, 38.1K, and the 1.38 at 38.2K. But by all means, you want to see a move to the downside. And as mentioned in the morning video, you'd probably be looking for a swing failure pattern setup over here. If price takes the high, then probably that is the high of B, and you want to move to the downside. So as this is the high, if we take this high again, of course, probabilities increase. You're going to continue to the yellow box, right? Which then invalidates this scenario in general. So the fact that, as mentioned in the morning, price wicked the high, then the entry is usually the moment the candle closes, stop loss above the candle over here, and then you're going to be looking for a move down. One can manage the trade effectively. Price already moved to the downside, so it's up to you and your risk management to put the stop loss break even or not in that case, of course. But in this particular scenario, if that is your high of wave C over here, which is then also the high of your wave B, you're looking for an impulse to the downside, where then your target is going to be, your main target is going to be wave C over here, as basically you have your wave A and a wave C, and an expanding flat ends below the low of wave A, with the most common target area of C being between the two 1.618s, which also includes this target box. But mainly I'm then looking for the target box over here. So that is a very easy invalidation. If price moves above, expectation is to move to the target box up there. If you then look at the probabilities of the different scenarios, then it didn't really change compared to this morning. Yes, we took the high, so we got a bit of new info, but it's now mainly about observing the reaction, as I always say, right? Not catching knives and all that stuff. Observe the reaction, give price some time, see what happens. CVD, RSI, stochastic, market structure changes, candlestick patterns, SFPs. Whatever you need to potentially enter or not enter a position or estimate your probabilities. In my case at the moment, based on Elliott waves, not what I prefer, the bearish scenario for me has a bit higher probabilities, meaning you will have eventually potentially a B and then a C to the downside. Of course, we do have that bullish scenario then in a diagonal. The thing is, of course, you have a 3-wave structure here and not an impulse, right? So the fact this is a 3-wave structure does not really give you a wave 1, 2 and a very big 3 vibe for very, very high prices. So even in a diagonal, you then expect price to move up. That's fine, for then eventually a bigger drop, where of course that yellow target box is going to be interesting resistance, or potentially that 39,440K area, right? In this diagonal structure at least. Now, if you then look at the probabilities in a potential order, this is just a very easy invalidation with the bearish scenario here for then a B and a C to the downside, right? Currently on number 1, easy invalidation as well. With on number 2, the bearish scenario going for B and then a C, and on number 3 at the moment, the leading diagonal structure, which also looks good, right? But just because of wave 2 being very short in the leading diagonal structure over here, and wave C still needs to extend to higher prices, right? Once price moves up, that becomes a probability scenario. Then the micro bearish scenario, of course, gets removed, and then these two over here remain. But now simply we wait for the reaction, observe the reaction, and then make our plans from there. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.